following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome back to the show. Friday night here in Asia. I hope you guys are having a good Friday morning. This is a big day, of course. Got the unemployment report coming out today from the U.S. guys that are going to put that out. Whether it's true or not true, we just got to go by those numbers and trade by those numbers. So we also have a pretty good treat coming up here today. We've got Eric Courtney coming back today about 8:20 right after the first segment. And what we want to do here initially is take a look at some of the things on the radar screen. Let's take a look at crude oil. And we're going to pull up the June contract. And as we look at crude oil, I mean, the long-term view, this 56.14 weekly on for a high, that's a big number that we've been talking about. But we've also been talking about kind of letting the inflection points on the daily to some degree regulate this trade up along with the 240s. We talked about support area yesterday, pre-market. Actually, we talked about 59.90, 60. We had two inflection points lining up in that general neighborhood. Was broken. Now what do? We talk about sitting on our hands sometimes, and I'm not a big fan of shorting crude oil unless we get again close below, and then we're coming back up into a trading opportunity around that 60 area again. So let's just kind of drill down a little bit farther. Let's take a look at the 240s. I'm a little still concerned about shorting crude oil, so let's just kind of keep talking about this for a little bit. Here's our 240s. Got a new profile appearing on the 240s here. But let's go back to our daily. The real crux of the situation here is we've got one thing that we look at for divergences that's not really happening right now is we made higher highs in crude oil. We really kind of continue to make higher highs in other things that we look at. But that being said, getting within the fair auction on crude oil, coming down from pretty lofty heights up here, we've had about a $4.50 pullback in crude oil in the last 36 hours, maybe 48 hours. 48 hours. We always talk about crossing the borders and then going back and using those borders maybe for a different reason. Now, 59.50 time of this report, 59.90, 60 up there. Are we supposed to short this rally in crude oil? In my opinion, you've got some trading opportunities here. I'm not looking at this from a long-term change of tone situation. I'm looking at it as we closed below some serious inflection points that we had to pay attention to, and we're coming back into that former support, now possible resistance. And I think we will have some short trading opportunities around that $60 area. It's a pretty significant psychological area that we crossed and kind of squeezed some people out of, and now we're kind of going back from the bottom and retesting that. And that, to me, may provide a little bit of a short-term trading opportunity. Make sure you put your stops in on things like this. As we look at this, we got to reference the dollar really, really quick. Crude oil's priced in dollars here, so dollar rallying, that obviously didn't hurt. Crude oil coming off just a tad here, but as we look at the dollar right now, we're coming into some 240 unfair highs here. We've got that big report. I think a lot of bets are off as far as the dollar, the euro, the S&Ps, the notes. I don't think you can really plan for what might happen with these numbers. I think a lot of fundamentalists are kind of like they've settled on the report probably will be a little less economic drive forward type numbers, like the guy's going to get the cheerleader at the end of the movie type stuff. I think they're, looking at this from everything that I've kind of gathered and people that I've talked to, it's just going to be kind of an off situation. So the only thing that could really that isn't already baked in the cake is a surprise on the stronger economic numbers, which, would take these notes. I'm going to pull this up. And this is one of the things Eric and I are going to be talking about today is a little bit about, the rate, global rate significance, what's going on now, maybe a sea change, maybe not a sea change, but you've had a chance to create a new orange bar. I think some people are getting out of this trade because of this reason right now, before this report, we've got an orange bar. That is usually indicative of a new profile attempting to appear on the 10-year. This is the 10-year, not the 30-year. And we're also on our weeklies on the 10-year. We're sitting right at major support. Now, we kind of caved in this week. We haven't had a close one way or the other to kind of predetermine, what kind of mode we're in technically right now in the long term, but that's just the way things are lining up before this report. So, again, to sum that up, a stronger report, better economic numbers would probably, continue to have the bonds and notes actually continue in the same direction, which markets seem to not like lower or higher rates. So we're going to have to just kind of watch how this relationship pans out. We always not advise, but we just kind of put this out to you that throwing the dice before some of these reports is probably not the smartest thing to do as a trader in general. Let's take a look at gold really quick. This is something that's just kind of churning around that level, that not a lot of direction here. And we talked about the next buy point probably down below 1173, 1171 sitting down here. It hasn't been hit yet. So that's kind of what I'm looking at. And up top, you've got 1210 on June gold. All right, just to go through all the usual suspects before we bring Eric on and then get into this economic report. I want to take a look at the ruble really quick. This is something that, we've talked about in the past. Eddie and I have, kind of been on the show together talking about this. This is a really good example on a weekly. Close below profiles long-term, go back and retest. And now you've kind of on a long-term basis really not had a lot of reasons to try to nibble down here. And you've had a lot of reasons to actually go short. As you can see, color-coded against profiles here. But let's just kind of drill down. Our dailies, we kind of use this to regulate the trade down, and breakdowns in the ruble below 49.34 going to have to be sold, and rallies up into 54.45 are going to have to be sold also. Had some questions about that. Let's take a look at the end. Now, this is something that's been my favorite trade since Tom and I have been talking about it since the 101, when we broke above 101.33. And we're 2,000 pips above there now. We've been looking at this from the long side only. We continue to look at this from the long side only. So buying support at 118.76 or breakouts above 119.68.69 are still in order on the yen, and we're kind of continuing to climb higher here. Here's the 240s. Here's the short-term support, not 119.96. Let's just call it 120. In my opinion, the yen has showed that relative strength for the carry trade versus the dollar. I still think this is the greatest trade on the books here from the long side, but put your stops in. Anything can happen. I'm still a huge fan of this. Let's take a look at the Australian dollar. They're cutting economic forecasts. They've lowered rates. It's been something that, in my opinion, should have caused this currency to go a little bit lower. It's just fighting it. That's concerning, actually. But we've closed below profiles, just like the crude oil trade we were just looking at. We're kind of hovering within this fair auction. I'm still looking at this, trying to use these leverage points up top around 79.19 now for a short opportunity. But again, be stingy with this. I've gotten stopped out of this trade myself. Beware that it can go higher, but I think we've got some odds on our side for this to go lower. Okay, a couple other things we want to look at. Let's take a look at the treasuries really quick. On the short term, we looked at the 10-year below before, but I just want to kind of pull out some short-term numbers because we didn't discuss this. 127.15, 16 up top right now. 126.31. Let's just call it 127 down below, and let's cover the 30-year really quick. Similar situation as the 10-year. Here's the situation on the long term. 158.14. We've kind of gone closed below last week, gone back and retested. You know, that's not very, lack of a better way of putting it, cool for the longs. Here's the short-term numbers on the 240. This is all we have to go on. 156.05 up top, 154.02 down below. Okay. Let's hit silver really, really quick. Charts are a little slow today. Here we go. We're getting populated now. 1625, we talked about that as a little bit of a support area for silver. It's kind of acted that way. Silver looking a little bit differently than gold right now. Excuse me. Let's get into the S&Ps just to cover the ground we always cover. We talked yesterday about, you know, we'd reached some target-rich environments down below 2063, 2068, and we talked about, you know, is it time to just step in and start buying this because we came down to support and we reached our targets? We talked about opting out on that because of our breadth situation. I'm going to pull up our breadth really quick. I mean, no harm done. And we talked about there was going to be some adjustments before this report came out today and some volatility. We had a pretty good run up, pretty good bounce at 20-point S&P bounce. I'm looking at our, let's see, let's get back to our S&Ps here. Let's get away from the ETFs. And here's the S&Ps. Still closed, believe it or not. This is why we're not a huge fan of trying to step in large on the long side right now. We've got our weeklies almost turning over to negative. We're above weekly and daily profiles. This is really weird. And dailies are still breadth negative. Let's drill down into this. Let's look at our statistics so you can see this firsthand. Okay. And 187 stocks trading below profiles, 87 above, 221 in the middle. This is not the type of bounce that I'm really feeling deep convictions on the long side with, so I'm staying away from the bounces and looking for opportunities to short this still. See if I can get our 240 chart up on the S&Ps. Here we go. Here's the short-term numbers. 2094 up top. That would be a resistance area in my mind. Let's take a break, guys. We'll come back. Eric will be with us, and then we'll get a chance to witness what happens after this report, after this next segment.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi guys, welcome back to the show, and I think we've got our guest on the phone with us. Eric, you there?
I am here, John. Good morning. Good morning.
Hey, good morning. You sound like you're right next door. I mean, this is amazing how we somehow use this framework at TFNN to just communicate and collaborate halfway across the world.
You've got your own. I mean, TFNN is phenomenal. I mean, more and more people I talk to don't know about it, but I'm getting them involved. And then with the scanner, it's like mathematics is a language. The scanner is a language. It's a whole different psyche, the way you put it. I've been listening to your show, and I think you do a marvelous job of explaining it, but there's a lot to it. It's like a philosophy. It's not just another site with a couple of numbers on it and colors, So I love it. You're doing great.
Yeah, we've done a lot of work on it lately. As you know, you've been patiently waiting for this work to be done. And I think we can do a lot of damage with this now. Make people make people believers of what we talk about every day. It really has helped my trading. And now I think it's a little, it's a little easier to kind of pick through this and make more sense of it. We're going to add features all the time. But first and foremost, Tommy and I and some of our tech guys got together this past week, and we are going to try to launch this Monday or Tuesday. Finally, we just had to figure out a way to kind of get the application over there instead of the web version. A little handicapped relative to this.
Well, it's like a good car. You got to adjust it. Most people in Italy, when they buy a car, they take it into the mechanic, and that's kind of what you've been doing a little bit with the the work on it. But now it's phenomenal, and in marketing it and selling it and talking to people, sometimes I have to really tear down their old ideas of what help and market computer algorithms are about, because this is different. This is a whole different sphere you're into here now, and it's just going to expand, I think.
Well, I appreciate it. I'll tell you what, we got a big report coming out at 8:30, and that is right after this break. Actually, we got about 2.5, 3 minutes to chat. I really want you to stay on after the report comes out.
Oh, I'd love to.
We had kind of decided before you called today, we were chatting that maybe we'd get into a little bit of a kind of a global rate talk, and some of the things. I just value everything you say, Eric. You're just like the most well-read guy I've ever met in my life.
John, I'm writing comedy now. I'm doing comedy writing for stand-up comedians about the economy. That's how screwed up things are. It's hilarious, really. It's fun. So go ahead. We'll chat whatever you'd like to. I mean, when I hear what you have to say about this, the economic situation we're in, I think you can use the word crush that Bill Gross used the other day. I think Bill Gross has been crushed a little bit. I don't know whether he was walking on the beach a little too long or what have you for a while there, but now he seems back. But he said, we're not going to see crash anymore. We're going to see crush. And there's a weight out there. And I know what the weight is about, I think. It's about interest rates and the economic scenario, and people don't have a good picture of the future. They don't see. They say, what are we going to have, 2% growth for the next 10 years? Where are we going? What's going to be the next dynamic thing to happen? And let's chat about that.
Well, you've kind of been talking to me all along during this low rate environment about, is this really good in the long run? And, timing is always, iffy when it comes to trying to figure out, when there will be a sea change, like, with this rate type environment. I mean, where do you think this is ultimately headed, and, how long can this low rate environment continue, and why would it continue, I guess, is the big question.
Well, I think from talking to people who have got the econometric table down pretty well, and that's always a debatable thing, but the ones that I know that are very intelligent feel rates are going to start moving up. Right. And then we're going to be back to a more normalized posture here in North America, especially the United States. I don't want to speak for Russia or China or Africa or other nations right now, but we can talk about that. But I think that rates are going to start to move up, and that's going to be the real, critical factor for us to enlighten corporate America and people to start thinking of growth again.
Well, Eric, look, I hear the music. We're going to take a little break, and if you can hang around, we would thoroughly enjoy it.
Yeah, we got the report coming out, too. I'll be right here.
Guys, we'll be right back.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
If you're like me, you see the world's emerging nations as a very real opportunity, as these countries and their economies are developing right before our eyes. And you can rest assured that Everbank has spotted this opportunity too. In fact, they just recently unveiled the new 5-year market-safe Future Economy CD. This is a CD that could really deliver, but you only have until May 7th to take advantage. Consider the facts. If the future economy's currencies beat the US dollar over the CD term, you'll get all the upside. And should they lose, no worries. There's zero downside risk here, as you still get back 100% of your deposited principal. Intrigued yet? The May 7th funding deadline is quickly approaching. So hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is an equal housing lender and member FDIC.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show. We've had the report come out. Eric, are you still with us?
Yes, I am.
Great. I'm showing the S&Ps, obviously. Let's see, just to kind of give you a tone of what's going on here. Bonds and notes have rallied, and we're having this big orange bar up here on the 10-year here. Having a little trouble with my charts right now, but S&Ps are real-time trading about 2,100 right now, 20.9975. The dollar, up a little bit. These are all, things I guess the market is temporarily enjoying. But as we look at the S&Ps, we talked about with our breadth situation at hand, and actually our daily numbers, even after the rally yesterday, still showing a pretty serious disconnect in the leaders of the pack and the rest of the pack. So a little bit of a bounce here, Eric. But we talked about some inflection points to pay attention to for the folks before the report. Can we get back into some of the fundamental things that we were talking about?
Yeah, I'd love to. I mean, the
Right.
consensus people were right on the number here with this one. They missed by 10,000 people in terms of the labor force. They had a 220 consensus at 5.4, which is, this is good news, basically. It's not, nothing, it's positive. So that's good. That's a good thing. But there's more deep problems, I think, than the minute-to-minute stuff we look at all the time. And I think the deep problems have to do with what is the long-term difficulty with having a prolonged low interest rate environment. And we have had a prolonged low interest rate environment worldwide, and it looks like it's going to continue. And I had a kind of take a look at the, you go back, if you go back over the history of interest rate, do you know you had to buy a chariot in the old Roman days, in the ancient days, it would cost you 40% interest. They had 40% rates then. The Roman Empire had a 10-12% interest rate scenario, 15%. The Dark Ages, of course, we had low rates because there was nothing going on, but you had a couple of spikes with the, you had the Crusades, cost a lot of money. Julius Caesar spent a lot of money. And then capitalism came along. We kind of stayed in a low-rate environment, but high rates were nothing new. And the bottom line is, if you look back, currency and interest rates is what created all of the opportunity in the world, if you look at it. The reason they came to the New World and Columbus got on that boat called the Mayflower, or whatever it was, not the Mayflower, but his Pinta, whatever those three boats, was to find gold, because they needed the gold to back the currencies. And currencies created havoc all through the centuries and interest rates. And the ups and downs, for example, in the 1600s and 1500s and 1700s, 75% of the time, Europe was at war, I mean, war was always an answer. And we've seen that in our lifetime, John, where war came into play with the Vietnam War was based on business. It wasn't based on communism. It was based on doing business, making more industrial, military industrial site. So I think if you look back over there, China is a different story. I mean, Marco Polo opened up the door there, and then Chinese had their own interest rate scenario. But domestically here, we follow what's going on and what has happened. And you can start really, I guess, with the Dutch. The Dutch were the ones who had the ball in their court for a long time on interest rates. They were trading interest rates in the Netherlands, and England wasn't as big on it as the Dutch, but they really were very, very sharp on trading. That's what made the Netherlands almost run the world for a long time, Denmark and those countries. Germany was also cute. Germany, during the 30-year war, which was a Protestant versus Catholic war, they had rates going up to 175%. So Germany has got a history of really being attentive to interest rates. It's not just the Second World War that caused them to be so inflationary concerned because of the problems they had. But so if you look over the history, you say, all right, so what do we do now? Where are we right now? What's happening when Bill Grove's talking about, he's being 70 years old now. And, I mean, I read the books he read by Julian Barnes. And basically the book says, when you hit 70, and I'm just about there myself, I'm going to be 70 in September, you start finding out you're losing things you had taken a lifetime to acquire. And they just go, the people disappear. You pick up the paper, you see this guy's dead, that guy's dead. You call it, all of those things happen. So we're in sort of an ennui, as they say in France, a sort of a stagnation, a little depression period, I think. And the market doesn't quite know what to do about it. Interest rates are going to be, as always have been, and currencies are going to be the key to pulling ourselves back together here. And I think what we're going to see is rates start to move up. But the problem, in the meantime, and I say meantime, time important, is that the longer we have this low rate of growth, the more people feel, what am I going to, why should I build a plant over there in Kansas? For what? The way the guys in the mathematical side of my firm, the treasurer on the math finance with these rates say that my returns are going to be 2%, 3%. I'll buy my own stock. I'll buy back the stock. I'll raise the dividend. I'm not going to hire anybody. Why should I hire? Why should Union Carbide go out and really train people and hire them and give them good jobs? The returns aren't there. Low rates mean low returns. That. Go ahead, John.
Yeah, let me give a couple updates on what's going on after this spike really quick, Eric, then I want to get back to that. And by the way, I really, really appreciate some of the background you give. I mean, these are obviously not timely intraday trading pieces of or tidbits of information. We're talking about, rates in Netherlands and 30-year war and all that kind of stuff. But a lot of people really kind of, I think, need to get their arms around like some of the things you're saying and kind of bring it back home into kind of more of a view than keep in the background, which basically is, this is kind of a never seen before type environment, and I want to get into like the downside of this type of environment in a little while, because you've kind of brought to light that this is really extraordinary is basically I think what you just said. And but right now the S&Ps have crossed the border, 240s, 2093, 2094. Now we always talk about trying to pick battles, trying to wait patiently, not being in the market during these reports, and then just kind of trading the reaction, not the initial action. And this is from a day trading standpoint, or swing trade standpoint, however you want to look at it. So right now, we're looking for, based on what we've been talking about with our breadth numbers the way they are, we're looking for a possibility of trying to grab an inflection point or two to get short. All right. Now, under our current circumstances, we would really need to get some confirmations and get back down below 2094. Otherwise, we are just kind of sitting here patiently waiting. I'm going to try to get my charts to snap here if I can. Why is that not working? Okay, here we go. On our daily, we just don't have anything up here. We're trading 2103 right now. Why is my chart not snapping here? I'm double clicking. Here we go. So we've had a significant move since yesterday's lows. We have nothing to grab onto here after this report, so we're just going to have to wait patiently. Now let's take a look at the treasuries really quick, see what's going on there. If we can get these to pop up. Gold is actually just settling back. We've been talking about possibly staying away from gold on the long side, at least temporarily here. We're looking for a little bit better numbers to kind of go after on gold for the long side. Here's the 240s on the 10-year. Here's the dailies. You've got that orange bar. New demand area probably going to appear at least by tomorrow. Here's the situation on the 10-year. Not a lot to hang on to there either. So both of these, unfortunately, are no trades. This is Friday. Remember that also. Eric, let's get back into, what does a super low rate environment, in your opinion, mean if we just continue to stay in this mode that we're in now relative to what's happened in the past, like you were just alluding to?
All right. Well, I think first of all, financial mathematics, which is what runs companies. The accountants run the companies. You can have showboat type leaders out there that run the company, and they get great speeches, but the real bottom line is accounting and the numbers. And do you know what? All the financial math, you can almost throw it out. I stop in bookstores and I look at all the books they have on business. I would tell you the best thing you could do is throw 70% of them out, because the things have changed now. We have to look. There's a big cloud in the assessment of financial risk on the part of all of the people that watch the numbers. They don't really know. And that uncertainty is what creates this sort of a crush environment, or sort of a weight. There's also a tremendous search for yield going on the part, with low interest rates, of everybody. How am I going to get a little better yield? In some parts of the world, they're giving you a negative yield on your passbook savings. CDs, of course, it's a benefit, but you don't make any money there. The only good thing about low rates really is mortgage rates. Cars, I think, at 3% right now rates. Mortgages 30 or 45% and all that. So what you have is everybody's searching for yield. What does that create? When you search for yield, you take more risk. A yield curve that is the way we have it now means that they're out there putting money. I mean, I'm going to, some guys are going to tell me, hey, well, you know where my retirement plan is? It's in the Russian bonds and Colombian bonds, because we get a good yield there. Well, let me tell you, the risk of doing that type of searching for yield always comes back and bites you. The other thing, third thing, are you there?
I'd like to make one comment on what you just said.
Sure, I'd love you to.
We're kind of in the middle of that type of trade, what you just said. Going out and searching for those, like, you hear the Russian 10-year equivalent, whatever, 17%. And Eddie's sitting right beside me here right now, and
Hey, Eddie.
he says hello. We really literally live this. You go
Yeah,
out and
I know you
search
do.
for that. You go out and search for that yield. You've obviously got to hedge the currency. And when you hedge the currency and then try to unwind that, what do? You try to find a Chinese broker or something like that on to swap rubles for the Chinese currency, and then you're paying the spread and all that kind of jazz, and then trying to convert it back into dollars. And it's not as simple, like you said, as people tend to, think, oh, I'll just do the Brazilian, treasuries and the Russian treasuries. Somehow I'm going to be a big winner. It's a little difficult doing those transactions sometimes to try to unwind that.
Very risky on the part of corporate America is sitting on the borderline of going over the edge and too much risk in the search for yield. So you got the cloud of the assessment environment, cloud trying to assess the environment of returns. You got a search for yield. Third thing I see is your balance sheet adjustments. We went through a whole period with the Great Recession of 8, 9, 10 of trying to correct the balance sheets, not only in the, in your home checking account, but in the corporate America. And now they're looking at what is the return. Again, I go back to financial math. How are you going to correct the balance sheets? Well, you know what they're doing? They're delaying it. They're putting it off. They're saying, all right, we'll get a better return here. Let's put this over here. Let's start some other type of accounting company here and move some money. The insurance industry is marvelous to watch, because that's you cannot figure. Insurance industry accounting is like Chinese algebra. Go figure it out. I can't. I don't know who can. Maybe one or two analysts. The next thing you're going to have, beside balance sheet adjustments and a lot of people trying to figure what is the valuation of the stock, what is the real value, what is the forecast? Well, the forecast is going to show low returns. So they're going to try to juice up the forecast by saying, oh, no, we got this new iPod, or we got this new thing that's happened here. We have a new, so they're hyping stocks. Stocks are selling on a huge hype that is not a financial baseline hype. It's a hype of dramatic. Here's the company here. Oh, we've got oil shale, and we got a new tank car we're going to create. So everybody's hyping their own stocks, and there's too much hype around, and that gets scary after a while. So you have corporate treasurers on the yield curve extending out as long as they can go. Now, when you go out on the yield curve a long way out to get a little better yield, you know what's going to happen. I think, as I said in the beginning, rates are going to go up, which is going to affect the prices of your long-term portfolios. So there's going to be a big adjustment. A final point that I'll make is the money markets are paralyzed right now because of all this. The volume in money market trading is what it was in 2003. So that tells you there's confusion.
You've been, listen, those are invaluable comments you made today, and I know all our listeners have thoroughly enjoyed this. Thanks for coming on the show today.
I appreciate you having me on, John. I'll talk to you soon.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to the Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Do you know the 7 most critical factors that influence every decision you make, and how not knowing these will jeopardize the health, the wealth, and the relationships you deserve? I'm Steve Rhodes, morning host at TFNN.com, and for the last quarter of a century, I've studied and used the secrets of human growth, the same formulas used by leaders of nations, billionaires and millionaires, and the most successful athletes on the planet. Would you like to break through any obstacle that gets in between you and the success you deserve? Would you like to turn fear into strength? If you could find a way to achieve, be fulfilled, and live a life of meaning, wouldn't you want to know the answer? I'll teach you the factors that control your state of mind and the drivers that impact every thought, emotion, behavior, and action we take in my new webinar, The Psychology of Trading. Join me for this 2-part online event where I'll unveil the secrets to human pattern recognition, because they're not what you think. And soon, you'll have the health, the wealth, and the relationships you deserve. Just go to the homepage of TFNN.com and click on The Psychology of Trading to begin your journey now.
Catch Steve Rhodes as he teaches techniques on technical analysis using pattern recognition, celestial charting, Fibonacci, and other tools. The Trader's Edge, next on TFNN.
Hi, guys. Welcome back to the show. And thank you, Eric, for all those great comments, fundamental stuff, and historical records. Love it. When he said something, Eric was talking about the Dutch. You know, I was. If you've ever been to, you know, Belgium or Netherlands, Holland, whatever you want to call it, there's a town a little south of, what is it called? Antwerp. It's called Bruges. This very famous, small, kind of really cool, villagey looking place that is extremely famous for chocolate. And that chocolate with the orange kind of stuff in them. I mean, it's just unbelievable stuff. But they have big, you know, jewel area, kind of Hasidic Jew, kind of, you know, Jewish little situation there. A lot of big expensive gems there. But one of the things I heard when I was there, I don't know if it was true, that they invented banking right there, and it was because they were standing on the bank of the river doing these, you know, transactions there. So that's where we get the word bank from, is what I heard. So anyway, but Eric made me think of that. So as we look at what's going on today, this is kind of my summary statement of the S&Ps and the bonds and the notes rallying. Again, you know, we've had a serious disconnect in the internals of the S&P. We've got the futures, obviously, just kind of a knee-jerk reaction, in my opinion. But we're going to have some new things to hang on to up top here, folks. And right now, we just don't have it. So until we get some new information happening, or we get below it, at the very least below 2094 on the S&Ps, you know, I think you need to sit tight This is not, in my opinion, this is not a buy the move up. We've got a lot of things pointing in the direction, namely some of our other momentum indicators, technically speaking, down below that we're just, with the breadth, the momentum indicators, the violent reactions with this, it's not selling me that it's time to step in large and start buying the S&Ps. It's time to still look, believe it or not, at trying to find some resistance levels, orient stops around those areas, and just, play that game. Again, we talked about not buying the dip into 63, 68 yesterday. That we talked about taking profits on the short side, in fact, but we've missed from yesterday's lows. It's a fact. We've rallied, what is this, 50 S&Ps in the last 24 hours. We can go higher, but we're looking for areas, again, to try to nibble on the short side and then maybe pile into it a little bit bigger if we can start breaking down on some levels and getting some deeper convictions on this. Let's pull back into gold really quick. Not a big fan of screaming buys on gold right now, just sitting tight with this. I know we've kind of climbed up a little bit. We're just settling back, but nothing to really hang on to for gold right now. It's just, in my opinion, going to churn around. Not yet the ripest opportunity to get long or short gold right now. So kind of staying away from that. Here we go. And let's take a look at the currencies really quick. Let's take a look at the euros before we go to end of our show here today. Euro, we didn't meet that 115 and some change area up top. That was the ultimate short. Why was that the ultimate short? Here's the weekly situation. Still kind of right in the middle of a big fair auction on the long term. Here's the daily. No new orange bars appearing. In fact, had this profile appear below a couple of days ago. That's why we continue to stay away from the short side on the euro. But the 240s, we've got a little bit of a breakdown here. We've got a little bit of a situation on the short term. You've got 112.91 up top. You can orient stops above there. But again, you're kind of directionless on a lot of these instruments right now. Guys, you've been great. Thanks, Eric, again. And stay tuned for Steve Rhodes. You guys have a really good trading day and have a good weekend. We'll be back again on Monday.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.